Okay, good morning, everybody. Is there any doubt till now? Otherwise, we will start with another standard. Any doubt till now? All good? Okay, okay. We'll start with impairment of asset. That is covered under IAS 36, or you can say Indian Accounting Standard 36. As we know, the numbering for IAS and Ind AS is same. Okay, impairment of asset. Anybody any idea about this? Any guesses?
So
Any yes?
at, during the end of a financial period, when the asset is supposed to diminish below its carrying value,
Okay, okay. Okay. Then
so
we
loss
are
of
required
value.
to loss of value. Okay. Okay. Very close. Impairment simply means we have to make sure that our carrying amounts are not overstated. Okay. This is done to make sure that the book values. Okay. Book value and carrying amount is one and the same thing. Book value or carrying amounts are not overstated in books. Okay. Or you can say in balance sheet. In balance sheet. Okay, just an example. For example, you have a machinery and your machinery is following, for example, WDV method. And because of WDV method, after charging 2 years depreciation, for example, on the reporting date, you see that, okay, your machine has been recorded at, for example, $1,000. But the real value, the fair value that you see around the recoverable amount, the realizable amount, okay, if you check in the market, is for example only $750. Okay, so the realizable amount is only $750. Whereas if we talk about the amount that have been recorded in the books of account is $100,000, $1,000. Okay, in this case, we can say that the machine amount is not presenting its correct picture. Okay, the machine amount is not providing its correct picture. It is not up to date. It is not up to the market values. And therefore, we can say that the machinery that has been recorded in the books of account is simply overstated, is simply booked with an over and above amount as compared to the amount that is expected to be recovered from this machine. Okay, so as an accountant, we can never overbook something, overbook extra gains and all. We can make a provision for expected losses, expected expenses, but we are not allowed, we are not permitted to book any expected gains, okay, or unrealized gains. We are not allowed to overbook anything. So, in order to correct this, we are required to charge impairment loss. In very simple words, the difference of 250 will be known as impairment loss. Simply, in this case, this is known as recoverable amount. We'll learn how to calculate what exactly it is. But the journal entry that you're required to pass is your machinery will get credit. Machinery, that means PPE. Your machinery, okay, your machinery, that is simply your PPE, property, plant, and equipment, will be reduced by this amount. That is $250. And what do you debit? You debit impairment loss. You have to debit impairment loss of $250. Okay. Now, this impairment loss will be generally shown in PL, but in case if it is related to any revalued asset, okay, then it might be shown towards OCI.
Not able to hear you.
Not able to hear me. Okay. Is it fine? Is it better now? Hello.
No.
Okay. Please check from your
Yeah,
side,
it is. It
Kishan.
is. No.
Okay. Okay. Good. 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 Okay. Uh, and say I was saying that this machine is unnecessarily overstated in the books of account, is overbooked, is recorded with a higher value, okay, as compared to the amounts that are expected to be recovered. Okay, so simply as an accountant, we are not allowed to record anything more over and above. Okay, we will be reducing this amount. Simply we'll be charging a journal entry, that is, we'll be reducing the machine amount, credit your machine, credit your PP by the difference amount. Simultaneously, what will be the contradictory effect? The simultaneous contradictory effect will be taken to your PL or OCI accordingly. If it's a cost based asset, if nothing has been previously charged to your OCI, then you'll simply charge your impairment loss towards PL. If your impairment loss is related to an asset which is following revaluation model, and earlier some profits on reval have been credited as revaluation surplus under OCI, then while charging impairment loss, you have to charge your impairment loss towards OCI first. Any doubt in this? The concept is the book's amount should not be overstated. It is very similar to the inventory funda. Inventory, for inventory, we always calculate cost or NRV, whichever is lower, and then we record it. In case if NRV is lower, we are required to reduce our cost and record it at NRV. Okay, give me a quick confirmation. Is it clear? Or please ask your doubt.
Can you please repeat the definition all about it?
Definition. See, this is not your actual definition. I'll tell you the definition and how it is calculated. This is just, I would say, in a very layman language, I'm trying to tell you that the carrying amounts should not be overstated in balance sheet. Okay? I have not shared the
Okay,
definition yet.
okay, got it, got it.
Got it? This is just, I would say, a simple example, simple explanation, so that you get the entire idea about impairment of asset. Later, we'll see its definition also, and we'll see how it is calculated. Any doubt?
No.
Okay, good, good. Okay, now next is how do you calculate this? Okay, now in order to calculate this, there are, I would say, definition that you need to know for calculation purpose. Okay, so first is fair value. Now, what is fair value? Fair value is calculated, okay, how under the standard IFRS 13, or you can say Ind AS 13. Okay, IFRS 13, or you can say Ind AS 13. IFRS 13, Ind AS, actually 113, sorry. Ind AS 113 says that how to measure on fair value basis. Okay, how to calculate is given under IFRS 13. Whereas specific standard tells you when to calculate. For example, property, plant and equipment. We said that, okay, if you are subsequently recording, if you are going ahead with the reval model, okay, then therein you will be required to calculate fair value on each reporting date. When to calculate is given under specific standards. Whenever a standard specifically requires that, okay, you need to fair value this and this amount, okay, you will use fair valuation. How to fair value is given under IFRS 13. Is it clear? Now, IFRS 13 says that fair value is an amount that is calculated under orderly transaction. What is orderly transaction? Orderly transaction means regular normal transaction without any influence, without any force. Okay, the buyer and seller were willing to enter into the contract, and therefore this transaction happened. That amount is known as fair value. Very simple. That is known as orderly transaction. For example, government compulsorily acquired a land and building, said that we want to build a highway and your building is coming in between, and we will compulsorily acquire, though they provide a compensation, though they are providing a consideration. But this is not an orderly transaction because the seller did not have choice in this. The seller was not given a choice. Instead, they had to agree with the government. They had to accept government's offer. Got it? So orderly transaction means a transaction without influence, without any force. Okay. It should be free. The buyer and seller both are willing to enter into the transaction. Second is between market participants. What is between market participants? Between regular buyer and seller. For example, you go to a regular shop, okay, for shopping your shoes. Whereas on the other hand, you go to your relative shop. Got it? So if you're buying from your relative and they might give you some extra discount, they might give you some extra privilege, benefit, extra service, okay, then that is not market participant. Market participants are the regular buyer and seller, which on and okay, during this transaction there is no biasness. Okay, there is no extra privileges given. Got it? A regular sale, normal sale, but any passing customer. Third, at the measurement date, fair value should be the most updated, most fresh value. Okay, for example, if you're making your balance sheet at 31st December, then the value should be of 31st December. It should not be of like 3 months back or 6 months back, 3 years back. The value was this, we cannot take the reference of the same. Fair value should be the most updated one, most recent one, most okay value. So what is fair value? Fair value is given under IFRS 13, okay, which tells you how to measure fair value. Okay, when to measure is given under specific standards. What is fair value definition? That amount calculated on any balance sheet date or any measurement date under orderly transaction between market participants. What is carrying amount? Carrying amount is simply your book value that has been recorded in the books of account. Okay. Next, value in use. Value in use is also a very important terminology, and value in use is simply calculated by doing present valuation of future cash flow. Okay. Whereas fulfillment value is also present value of future cash flow. The difference is that this term is used, this term is used for asset, whereas fulfillment value is the term used for liability. Any doubt?
Can you please explain this value and use like fulfillment value with one example?
Definitely yes. Okay. Fulfillment value, for example, um you have a supplier and you have taken your raw material and you have booked it at $1,000. Now, you are expected that if you will settle, the creditor will always, the supplier tends to give you 10% discount on settlement. Got it? So this means your fulfillment value is not $1,000. Instead, your fulfillment value is $900. Got it? The actual outflow that is expected on settlement. The perspective is to settle off that liability. The amount that will be payable on that settlement date is known as fulfillment value. Got it? Is it clear?
Yes, clear.
Okay, good. Any other doubt?
No.
Ari Shankar, is my audio clear?
Yeah, no doubt, clear.
Okay, okay, good. Okay, next. Now, how do you calculate your impairment loss? How do you calculate your impairment loss? First is fair value less cost to sell. Firstly, you will calculate fair value less cost to sell. Okay. Then you will calculate value in use of that asset. That is your present value or future cash flow. Okay. Now, for example, you have got an amount. Now, you have to check whichever is higher. Whichever is higher. Whichever amount will be higher, okay, is known as recoverable amount. Okay, in short, we'll refer it as RA. Not for exam purpose, just for our understanding purpose. So first step is to calculate fair value less cost to sell. Second step is to calculate value in use. Okay. Now out of both of them, whichever is value is higher will be taken as recoverable amount. Note it down simultaneously. Give me a quick thumbs up. Is it clear? Good, 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 good. Okay. Now we have carrying amounts that is already recorded in books of account, and we have recoverable amounts that is already calculated here. Now you will compare them both. Then you will compare them both. Okay. Now, if carrying amount is less than, if carrying amounts are lesser than recoverable amounts. Okay. If carrying amounts are less than recoverable amounts, then we say there is no impairment loss. No impairment loss. But in case if carrying amounts are higher as compared to your recoverable amount, this means your carrying amount, your book value has been overstated. Then in that case, you are required to, okay, book impairment loss. Is it clear? If your carrying amounts are okay, all right, below the recoverable amounts, okay, do not record, do not adjust any amounts. Whereas if your carrying amounts are overstated, are higher as compared to the recoverable amounts, you are required to book the difference as impairment loss in the books of account. How will you record that impairment loss? You will reduce your asset amount and you will debit your impairment loss in the statement of PL and OCI. If it's related to normal cost model, and if nothing has been earlier charged towards reval surplus under OCI, you will simply charge your impairment loss towards PL in very general cases. But in case if you are following a reval model and you have earlier charged any reval surplus in the OCI, then while charging impairment loss, the impairment loss will be shown under OCI. Is it clear? Good, good. Very good. Okay, next. A quick example to clear this off. Henry Company holds an item of machinery which it believes is impaired. Okay. Uh, to this is known as impairment review. Whenever there are indicators, therein you have to undertake impairment review. Whenever there are indicators, then you undertake your impairment review. For example, what happens if your mobile phone, okay, falls from a height? This is an indicator that something might have happened, and then you pick up your phone and then you analyze where is the crack, is there any damage? Got it? Similarly, if there is any indicator, it can be any macro factor, it can be any micro factor, it can be, I would say, related to the machinery itself, or it can be from the outsider. Okay, outside the economic changes have become, okay, there is some other technological update, anything might happen, because of which there are chances that the value of the current asset might fall. Got it? So if there is an indicator, you undertake impairment review. Okay. So here Henry Company is believing that there are chances that its asset have been impaired. The following information is relevant. The fair value of the machine is given $10,000 and the cost of selling is given $500. Okay. The value and use of the machinery is estimated $9,000. How do you calculate? Your first step is to calculate fair value less cost to sell. Okay. Second amount you will calculate, that is value in use. Here it is directly given. Sometimes the question does not give you the direct amount. Instead, you are required to do the present value calculation. Okay, we'll see how it is done. So fair value is $10,000. Cost to sell is $500. Okay, so this means your fair value less cost to sell is $9,500. Whereas value in use is directly given, that is $9,000. Now, to calculate recoverable amount, whichever is higher or lower, how do you identify your recoverable amount?
The lower one.
Whichever is higher. Whichever is higher is treated as your recoverable amount, and that is 9,500. That is 9,500. Okay. Now, as soon as you have got your recoverable amount, you will compare it with your carrying amounts. Second step is to calculate carrying amount and recoverable amount. Your carrying amounts are not given here. It is given carrying amount of the machine is 10,500. And your recoverable amounts are 9,500. Is your carrying amount overstated? Is your carrying amount overstated? Yes or no?
Yes.
Okay. This means you are required to book impairment loss. You are required to book impairment loss. Book impairment loss of $1,000. Okay. And it will be recorded in PL or OCI. It will be recorded in PL or OCI because the machinery is following historical cost method. Will it be recorded in PL or OCI?
PL.
In PL itself. Okay. Why? Because earlier they have not charged anything towards their OCI because they are following cost model. So we have answered both the things. The question was asking you to answer recoverable amount. Your recoverable amount is 9,500. It is asking you to calculate impairment loss. Your impairment loss is 1,000. Any doubt? Quickly check your note. It is whichever is higher is your recoverable amount. All good? Good, good. Okay. Now, quickly check. There are some indicators because of which you have to undertake impairment review. Those can be macro, those can be micro factors, internal and external factors, because of which it is providing an indicator that okay, your carrying amount of the asset might be overstated. Got it? You have recorded your mobile phone at 50,000 rupees in your balance sheet. Okay, but today it has fallen into some water or it has been badly damaged, it has been crashed, and might be your resale value is only of 2,000 rupees. Okay, so because it has been crashed today, okay, it was severely damaged today, it is an indicator that the book value of this mobile phone might be overstated in your books of account. Okay, so these indicators tell you that okay, let's check the impairment review. Got it? What are those indicators? Firstly, those are observable indicators that the value of the asset has declined during the period of significantly more than the expected due to passage of time or normal use. Simply, the machine was expected to be used for next 10 years, but because of some difference in usage, okay, because of some changes either in usage pattern or machine functioning, the machine is showing that it will get wear and tear within 8 years. Got it? For example, you have bought a car and you felt like, okay, its useful life is, for example, 10 years. But due to some damage, due to some engine failure, etc., it feels like this model is not up to date, up to the mark that we thought of. It won't work more than 6 years. Got it? So observable indicators because of which, okay, okay, which has declined the value of the asset more than the expected. Next, significant change, which is adverse, that means negative effect, significant on the entity. Example in the technological. For example, you had a super good phone which was supporting 4G. Okay, and it was highly saleable. Again, today itself, the network company announces that now onwards, today onwards, 5G is applicable. We are bringing in 7G next month. Example, your phones which are compatible till only 4G internet speed will get deteriorated. Got it? Will get out of market soon. Will be replaced soon. Are we clear? Please understand this significant changes. For example, a very good change that I have observed that I had a friend which had a very good factory and they used to follow polythene. They used to manufacture polythene, thermocols and all. Okay, and they were super rich. They were having super good existence of business. We are in Rajasthan and suddenly the Rajasthan government announced that we are banning polythene. The business which was at its peak, okay, went to zero within a day. Got it? So because of any economic changes, any law changes, any government policy changes, okay, there is any change in the technology, because of this, the existing product's value might fall. Are we clear? Good. These are some of the indicators because of which there are chances that your book value of the asset that have been recorded in books might be overstated. Next, increased market interest rate or other market rates of return affecting discount rates and thus reducing value in use. Okay, I'll take an example of the same. It is saying that increased market rate. Okay, for example, you have 1,000 rupees in hand and there is a 7% interest rate going on in the market. Calculate PV factor for 1 year at the rate 7%. Can you calculate PV factor? How do you calculate PV factor? 1 divided by 1 point rate. What is your rate? 0.7. If you are calculating for 1 year, you have to give power for 1 year. If it's 3 year, you have to give power for 3 years. Got it? Right now, we are only taking the value for 1 year. So what is your first year's PV factor regarding 7% rate? Okay, Harishankar. Kishan, please tell me till then, what is your present value factor? In your calculator, press 1, press divide sign, and then press 1.07. Okay. Then press equal to button.
Just a moment.
Sure.
You have to try. It's 93.
93.
0.93.
0.93. Okay. 93 or 934. Got it? If you multiply this, your present value will be, okay, 934. Whereas, for example, the rates have now increased. The government rates, the market rates, interest rates have increased. Now, if you calculate your present value factor, it will be, try to calculate just for 1 year.
Moment. It's 90.
90, okay? 0.909. Okay, or you can say 91. How are you calculating? 1 divided by 1.1.
That's correct.
Okay. So this means your amount will be 909. This is how you calculate value in use. How do you calculate value in use? Value in use is calculated using present value of cash flow. So your cash flow is 1000 rupees and your present value will be calculated by multiplying the present value factor regarding the rate, effective interest rate. Got it? So this is your value in use.
One question.
Yes. Yes.
This is the way we can calculate interest on amount that we keep on our bank.
Interest in a bank will be 1000 into 7%.
Okay, it will be 70.
Yes. Okay, this is your interest amount. Present value factor is simply calculated. Why? Because, for example, 5 years back, if you could purchase, for example, Maggie, okay, 10 rupees Maggie used to come, okay, Maggie packet. Whereas nowadays, if you look here, can you buy Maggie packet within 10 rupees? No, it's now worth 12 rupees. Got it? So this means the power of this is like beating the inflation factor. Okay, the value of 1 lakh rupee today, 10 years back and 10 years later won't be same. Okay, got
Just
it?
to calculate the inflation factor.
Inflation factor, change economic factors. Okay, earlier within 100 rupees, most of the grocery could be bought, but today within 100 rupee you cannot even buy your green grocery. Got it? So this is like putting in the impact of, including all the impact of inflation, changes in time. This is like considering your time value of money. Okay, keeping all the inflation factor, okay, under, I would say, consideration. Got it? Good, good. Okay. So see what happens. Now, fair value, less cost to sell. And for example, value in use. Got it? Whichever is higher, is your recoverable amount. Okay. For example, right now fair value in less cost to sell is not given. Let's take it 0, and value in use is given 934. This means your recoverable amounts are 934. Is it clear? Is it clear? Okay. And for example, your carrying amounts are, for example, your carrying amounts are 950. Okay. In case 1, if your recoverable amounts are how much? 934. Is there any impairment? Is there any impairment?
20, 21. Sorry.
21. Okay. If recoverable amounts are higher, the carrying amounts are not overstated. Since carrying amounts are not overstated, no impairment loss. Is there any confusion? If the
Oh,
carrying amounts are not overstated, there is no impairment loss. Okay,
got it.
got it? Now in second condition, for example, your value in use is now 909. This means case number 2, again your carrying amounts are rupees 915. Okay, and your recoverable amounts are 909. Is there any impairment loss?
6. Almost 6.
Yes. Yes.
Rupees 6.
Okay. Okay. Why? Because here the carrying amounts are overstated, but here it was not overstated. Clear? Now see, because of this, please understand the recoverable amounts fall. The recoverable amounts fall if your interest rate increases. Read it again. If your interest rate increases, your recoverable amounts fall. If interest rate increases, your recoverable amounts fall. Okay, because of which, okay, and carrying amounts are same. And assume carrying amounts are same. If carrying amounts are same, and due to increase in interest rate, if your recoverable amounts fall, then there are chances that it might lead to impairment loss. Okay, this might result in impairment loss. Is it clear? Okay, this is very important. Please write it down in your books. Take this example. Now read the indicator. Note it down. If interest rate increases, this means your recoverable amounts will fall. If your recoverable amount will fall, then there might be chances that it is resulting into impairment loss. Okay. Read this line. Read the third pointer. Are we clear?
Can
Are
you
we
show the
clear on
chart
the,
one?
yes? Sorry?
Can you show the chart once? So I'll put it on. Yeah.
Okay, is there any doubt? Anybody, any doubt? Okay, good. Okay, next, carrying amount of net asset exceeds market capitalization. Okay, what is market capitalization? For example, number of shares into market price per share. For example, nowadays the market price is going on, for example, $30 per share and shares are 100 shares. So it is $3,000. But the net asset that has been recorded in books of account is, for example, $3,500. So if your net asset in the books of account are higher as compared to your market value, this is market value, this is almost, you can say, this is your recoverable amount. This is your carrying amount. So if carrying amounts are higher as compared to recoverable amounts, then this means the difference should be treated as impairment loss. Okay. Internal sources. Any doubt in here? Please raise hand. Please ask. Okay. Next, internal sources. Internal sources, for example, there is evidence of obsolescence or physical damage. Either the asset have been damaged physically or there is obsolescence. For example, you are having a brand new typewriter, okay, which is typing like, for example, 500 pages a day. But suddenly a new photocopy machine is introduced in the market. Your typewriter being super speedier, okay, super good, but still it will be replaced by photocopy machines. Okay, for example, it will be replaced by computers. So nowadays, if you see, okay, typewriters are very rarely used. Whereas if we talk about computers, photocopy machines, these are more into picture, okay, are more into market. So we say that there can be any obsolescence or there can be any physical damage. Next, significant changes with an adverse effect on the entity. There are changes and it is affecting entity. For example, including the asset becoming idle, plans to discontinue or restructure an operation to which the asset belongs or to dispose of it earlier than expected, and reassessing the useful life of an asset as finite rather than indefinite. Finite means countable, whereas indefinite means cannot be counted, cannot be estimated today. So, for example, you said that, okay, I have bought this machine and this is super good. This is long lasting, everlasting. Okay, this is timeless and I'll use it till my business runs. But suddenly, because of changes in any internal or external, okay, environment, because of this, now the useful life of that asset has now become countable. It can be said that it is not timeless, it won't last forever. Instead, we can say that it is now, it will last for 5 years, 10 years. So, from finite years, if your useful life changes to from indefinite years, if it changes to finite years. For example, earlier it was uncountable, cannot be estimated, but now you can take an estimate of a limited useful life. Then this is also an indicator that there are chances that your books of account might be overstated. Okay, your asset might be overstated in books. Is the second point clear about this? From indefinite life, if you are coming back to finite life, that is, if you are reducing and if you are limiting your life of that asset. Okay, earlier you said that cannot be estimated. We do not know exactly how much it will last. But now you are able to estimate that, okay, it will last for only next 5 years, 10 years. Got it? If you're trying to restructure or discontinue the operation, then the existing machines, okay, might have to be sold at scrap value. Got it? If it was, uh, I would say, running business, okay, if the factory was in operating condition, therein, if you sell this factory, then it will be sold at a very higher amount because it is uh, generating economic benefits. Whereas if you shut it down, if it's not operating, okay, if the market things have changed because of this, now if you sell your machine, okay, it might be sold at very lesser amount. Okay, so if you are going ahead with, if you are expecting any changes in the restructuring means changing your, I would say, location, okay, or any other, you're shifting from one formula to another, one, I would say, one platform to another. Next, internal evidence available that asset performance will be worse than expected. There is internally information has come up that okay, the asset will not be performing great, instead it will be at lesser productivity, lesser, I would say, performance. Then in that case also you have to record, you have to undertake impairment review. These indicators trigger impairment review. After impairment review, you get recoverable amounts. Then you compare recoverable amount with carrying amounts. If its carrying amounts are higher, then you have to record impairment loss either in PL or OCI and reduce the simultaneous asset amount from the books. Anybody, any doubt? Anybody,
Is
any
there
doubt?
is there a
Yes,
possibility of reversal of impairment?
definitely yes. Yes. Okay. And it is covered in your standard IS 36 itself. Later, we'll understand it. Firstly, we'll understand another topic. And in the last, I'll tell you how the reversal happens and what is the maximum limit up to which you have to restrict your reversal of impairment. But yes, the answer, okay, is yes, that impairment loss do get reversed.
Okay.
Okay, but there are some conditions and some limitations. Okay, good. Any other doubt? Okay, our next topic is cash generating unit. Okay, let's take a quick break. We'll connect back at 8:20 and we'll continue. Okay.
Okay.
Okay, let's continue. Okay, cash generating unit. Are we back? Please confirm. Okay. Now, what is cash generating unit? It is simply the smallest group of asset which is capable of generating sales. Okay. For example, Domino's. It works on franchisee model. Each and every outlet that has been opened up, there might be like thousands of outlets. Each outlet is capable of making sales, is independently, I would say, taking care of its expenses, its employee expenses, renting expenses, their raw material, ingredients expenses, etc. Then each and every outlet can be considered as cash generating unit. Okay. Similarly, we can talk about multiple brands. Any shoe brand, any cloth brand. Each and every unit, whichever is able to make a sale, generate inflow, revenue on its own, can be considered as cash generating unit. It is the smallest independent group of asset that can generate cash. Are we clear till here? Smallest independent group of asset that can generate cash. Okay, quickly confirm. Give me a quick thumbs up. Good, good. Vision. Okay, good. Now, there might be possible that the group of asset is there and it has a value. Okay, net asset of that group must be having some value. For example, 1 lakh. Now, you have to compare and check what is their worth, what is their recoverable amount. For example, if the net asset, okay, that has been recorded in the books are over as compared to the recoverable amounts. For example, if I say that the net asset of cash generating unit is $100,000 and the recoverable amounts, okay, are, for example, $80,000. Okay, this means your carrying amounts are higher. If carrying amounts are higher, you have to book impairment loss. But there is a little difficulty. Earlier we discussed the same scenario, but there was one asset. Your machinery was overstated, and therefore you reduced your machinery amount by that difference amount and booked your impairment loss. But herein, we have so many assets. There will be machinery, there will be furniture, there will be, okay, other assets. So many assets. There will be copyright, patent, goodwill. There are so many assets. How to allocate, how to charge impairment loss? How do you reduce your impairment loss from each and every asset? How do you allocate? Okay. So firstly, you have to understand cash generating unit. Secondly, if it is overstated in the books of account, you are required to record impairment loss. How do you record your impairment loss? This is your third step. Okay. First is you always charge your entire impairment loss towards goodwill. Firstly, entirely everything, whatever the impairment loss is, will be charged towards goodwill. For example, okay, just an example. This current asset has this carrying amount of 100,000 has multiple assets. One asset is, for example, goodwill, and goodwill is of $5,000. Total impairment loss is 80,000. Recoverable amount is 80,000. Sorry, this means your impairment loss is of 20,000. This impairment loss of 20,000 will be firstly deducted from goodwill entirely. Still 15,000 remaining, that will be attributed to other non-current assets. Okay? Is it clear? One thing that I want to highlight about our previous slide is that impairment loss happens only for non-current asset. You never check impairment. Okay, it can be tangible, it can be intangible. It can be tangible, it can be intangible. But you always check impairment of asset. You always undertake impairment of asset. You always book impairment of loss only and only towards non-current asset. Current assets are not affected by impairment loss. Current assets are not reviewed for impairment purpose. Clear? Non-current asset, either it is tangible or intangible. Both are covered. Okay? Keeping this in mind, non-current asset, either tangible or intangible. Keeping this in mind, impairment loss will never charge to current asset. Okay? Impairment loss will never be charged to current asset. Next, impairment loss will be charged to remaining non-current asset in their carrying amount ratio. Okay, in their carrying amount ratio. Note it down. We'll take a good example for the same and then we understand its application, how to record impairment loss in case of cash generating unit. As soon as you're done noting, please give me a thumbs up. If there is any doubt, do ask. Good, good. Good, very good. Okay. Let's take an example. For example, we have a cash generating unit which has so many assets. It has goodwill, it has PPE, it has investment property, it has current asset. The total carrying amount of cash generating unit, which is known as CGU, cash generating unit, is 8,25,000. Now, after impairment review, you came to know that there is a loss of $100,000. Okay, there is a loss of $100,000. Now, which asset should be deducted by what amount? Which asset will be deducted by what amount? Okay, so quickly note this example. This is super important. There are so many questions and examples like this. You know the formula, you know the method, you know the priority which to be charged where, then it is very easy to solve. Okay. For example, there is a cash generating unit which has 4 assets and the total is 8,25,000. There is an impairment loss of $100,000. Okay. Now you have to attribute this impairment loss towards each and every asset. How do you tackle the same? So firstly, the impairment loss of 100,000 will be charged towards goodwill. This means goodwill will be deducted by $25,000. Okay, entire goodwill. For example, the loss was of only 20,000, then your goodwill would have been 5,000 still remaining after charging 20,000 loss. Okay, so this means your asset, your carrying amounts, these are your carrying amounts. Okay, your carrying amounts will be 0 for the goodwill. Now you have 75,000 loss still remaining to be allocated towards remaining assets. Very important, you never charge any impairment loss towards current asset. Okay, you never charge any impairment loss towards current asset. This means your current asset value will still remain 50,000 after impairment loss. Okay. Next, what are the non-current asset? This is also non-current asset. This is also non-current asset. Okay. Remaining loss is 75,000. So 75,000 will be attributed to PPE and investment property in their carrying amount ratio, that is 3 lakh is to 4,50,000. Okay. So you can say 75,000 into 300,000 divided by 750,000. 75,000 into 450,000 in the carrying amounts of these non-current assets, whether it is tangible asset or intangible asset. Okay. So this means 30,000 will be attributed and deducted from PP and 45,000 will be deducted from investment property. Okay. You have to deduct 30,000 from PPE and you have to deduct 45,000 from investment property. So this means it is 2,70,000. 4,50,000 minus 45,000, that is 4,05,000. Okay. Please calculate 270 plus 45 plus 5,000 plus 50,000. That is 7,25,000. The carrying amount of the group of assets under CGU was 8,25,000. You have to charge impairment loss of 100,000. Okay, thereby resulting that now the carrying amounts will be reduced and will be recorded in the books at 7,25,000. How it needs to be attributed? Firstly, charge towards goodwill. Secondly, never charge anything towards current asset. Thirdly, anything remaining will be attributed, allocated towards the remaining non-current asset, whether they are tangible or intangible, in the ratio of their existing carrying amounts. Please confirm. Any doubt? Good, very good. Okay. So, keeping this in mind, okay, let's be more clear. When sometimes question is asked, identify cash generating unit. They will give you 2-3 scenarios and you are required to identify which one is cash generating unit, which is not. Okay. Secondly, the questions can be asked that group of asset is given, their carrying amounts are given, and impairment loss is given, and you are required to allocate the same. Okay. So read this. Read this example. This is given in your workbook itself. There is a mining company which owns a private railway that it uses to transport output from one of its mines. Okay. The railway now has no market value. Has no market value other than as scrap, and it is possible to identify any separate cash inflows with the use of the railway itself. Consequently, if the mining company suspect an impairment in the value of railway, it should treat the mine as a whole cash generating unit. These are just examples given, and measure the recoverable amount of the mine as a whole. Okay, so herein it is saying, since mine is capable of generating cash on its own, is independently working, in case if the scrap value is negligible or the residual value, recoverable values are negligible, then you have to compare carrying amount and recoverable amounts. If carrying amounts are higher, you have to book your impairment loss. How will you book your impairment loss? Considering as if these carrying amounts are related to cash generating unit. Next, a bus company has an arrangement with a town's authority to run a bus service on 4 routes. Okay. in the town. Separately identifiable assets are allocated to each of the bus routes. Okay. And cash inflows and outflows can be attributed to each individual route. So it says that there are separate buses for each route. Okay, separate assets are there for each route, identifiable assets. 3 routes are running at a profit and 1 is running at a loss. There are there are total 4 routes. Routes means the pathway from one point to the last destination point, between which the bus will operate. Okay, this is your routes. The 3 routes are running at a profit and 1 is running at a loss. The bus company suspect that an impairment of asset on the loss-making route. However, we have to consider, the question is whether you should consider each and every route as separate cash generating unit, or whether you should consider all the 4 routes as one single cash generating unit. Any guesses? Any understanding of yours? There are 4 routes. Each route has its own asset. Each route is making their own cash income. Now, whether you should understand and calculate and consider all the 4 routes as one cash generating unit, or whether you should pick one route as one cash generating unit.
Or will be shown as different.
All should be considered as separate cash generating unit. Okay. Any other pointer? Any other opinion? Either yes or no. Okay. Please tell me any other opinion, any other input.
I agree with you.
You agree with him. Okay. See, here the case is that the arrangement, there is one single arrangement. And it says that they have to work on all the 4 routes. Okay. To continue with the contract, you have to work for all the 4 routes. You have to operate on all the 4 routes. Is it clear? You cannot close down any one route and operate all 3 others. This means these all 4 routes are not independent. Instead, they are interrelated, correlated. Even if some route is making loss, still you cannot say that, okay, I will not operate any of my buses on this particular route because it is making losses. Otherwise, all 3 routes I will operate. Okay. Then you have to end this contract. Please understand, to continue this contract, under this contract, you are required to run buses and use all, whether it's profit making or loss making, you have to operate on all the 4 routes. Okay. Considering this, we are saying that these are not independent. Instead, all 4 bus routes should be taken as one single cash generating unit. Clear? Why we are saying? Because they are independent. If we talk about, like, for example, if as we took Domino's, okay, if one outlet is not working, you can close it down. Okay. If one outlet is not working, it closes down, it shuts down. Are we clear? So it has to be cash generating as well as it has to be independent. So your independence is not there. Therefore, we cannot bifurcate and say that these are all 4 separate cash generating units. Harishankar, is it clear? Good. Okay. Okay. Next, one more example. Minimart company belongs to a retail store chain called Maximart company. Okay. Chain of Maximart company. Minimart company makes all its retail purchases through Maximart company purchasing center. Pricing, marketing, advertising, HR, except for hiring Minimart's cashier salesmen, are decided by Maximart. Maximart company also owns 5 other stores in the same city as Minimart and 20 other stores in other cities. All stores are managed in the same way as Minimart. Minimart company and 4 other stores were purchased 5 years ago and goodwill was recognized. Which factors will make Maximart company consider when determining if Minimart company meets the definition of cash generating unit or not? You have to identify whether Minimart can generate cash. Is Minimart able to make sales? Yes or no? Minimart can make its own sales.
Yes.
Okay, good. Second, you have to identify whether it is independent or not. Can it operate on its own? Can it be closed down if required, if it is loss making, if Maximart chooses to? For example, there are 25 stores in total, 5 stores in the same city and 20 other stores in other cities. Okay, so is it possible to shut down that particular store? Yes or no?
Yes.
Yes. Okay, please read the answer. On this basis, since it is independently generating cash and it is independently capable of being operated as well as being shut down, though it is getting all the instructions regarding pricing, marketing, advertising from the Maximart, though Maximart is governing, instructing about these, but since it is separately generating cash, it can be separately operated as well as shut down. We say that it is independent. Since it is independent, then Minimart can conclude that it is a cash generating unit. Internal management reporting is organized to measure performance store by store basis. You can shut down and carry on business store to store basis. Secondly, the business is run on a store by store profit basis on a or not on a region basis. It is not that in this city you have to run 5 units. You cannot close down any unit. If this was the case, then we would have said that this Minimart is not your CGU and not be considered as CGU. Independently operating store by store can operate, can shut down. This decision making is there. They are not signing a contract of opening or working entire 25 stores as one contract. No, it's not that. They can open up new 26 store as well. Okay. Next, try to calculate this. Calculate impairment loss using the information. I'll be back in a minute. Okay. Try to solve this example. Okay. Any answers?
$0.2 million.
0.2 million. Okay. Any other answer? Any other answer? Okay. Any confusion in solving? Question could not. Okay. Okay. To calculate, we need to understand carrying amount and recoverable amounts. What is your carrying amount given? Carrying amount is given 3 million. We have to calculate recoverable amount. How do you calculate recoverable amount? Fair value less cost to sell. Okay, and value in use. Okay, please tell me, have you identified fair value less cost to sell? Vishnu, could you identify fair value less cost to sell?
$0.5 million.
0.5 million. Fair value less cost to sell is 2.8 million. See, company has received an offer. This means if you go and try to sell this asset, then you'll be getting 2.8 million. The company has got an offer of 2.8 million for the platform from another oil company. Okay, the bidder would take over the responsibility and cost for dismantling and removing the platform at the end of its useful life. Okay, it says that cost to sell is 0, and the company has received an offer. This is your fair value. So 2.8 million minus 0, that is 2.8 million. This is your fair value. Okay, the value that you could get from the market if you go ahead with selling this particular item. And there is no cost to sell because the buyer is saying that, okay, you do not have to put in the efforts to dismantle and relocate and restore the sale. I'll do the same. Okay. Kishan, quickly confirm fair value less cost to sale 2.8 million. Do you agree? Do you understand?
Yes.
Okay. Now comes value in use. Value in use is present value, okay, of cash flow. Okay, this means 3.3 million. Plus, it has a carrying amount of outflow. See, this is your inflow and this is your outflow. This is your outflow. If you go ahead, then you have to calculate value in use of net cash flow. Everything that is coming in minus anything that is payable. So 3.3 million will be an inflow for the company, whereas company is required to dismantle the sale, and therefore it will require 0.6 million for dismantling amount. Got it? So this means 0.6 million. This is your inflow and this is your outflow. Inflow and outflow. Okay, so this is your present value of net cash flow. What is it? Present value of net cash flow 3.3 minus 0.6, 2.7 million. What is your recoverable amount? Recoverable amount is whichever is higher. So your recoverable amount equals to 2.8 million. Is your carrying amount overstated?
Yes.
Therefore, the impairment loss will be difference, that is 0.2 million. Any doubt?
Clear.
Clear? Good. Okay. Okay. This is the solution given in your book. Next. Okay, you can try this example. It is very similar, very simple one. You can try this example. Please let me know, is there any doubt? The total loss on impairment is 1.4 million. Good, good. Okay, now 1.4 million will be firstly charged towards goodwill, that is 0.5 million. Okay, the remaining 0.9 million will be attributed to other assets. Okay, next. We've already done this. Now, next topic comes is reversal of impairment loss. Reversal of impairment loss further in upcoming years, if there is a good indicator, a positive indicator, okay, then in that case, it might be that, for example, your carrying amounts are, and your recoverable amounts are. For example, further, the recoverable amounts get higher. Okay, for example, 1 month. Then in that case, if recoverable amounts are higher, it shows indicator for reversal. Indicator for reversal of impairment loss. Okay, for example, you had a machine and due to this COVID lockdown, you have reduced it and impaired it, and you were like, no more, it won't be used more. Okay, therefore, you have recorded your asset at a lesser value, you reduced and you recorded an impairment loss, for example, of $100,000. Okay, later, after the COVID, lockdown situation came into control. Okay, lockdown was stopped, was ended. 6 months later, you said that no, the machine is still into usage, is still able to provide economic benefits, and now the recoverable amounts are better. Now there are no adverse indicators. Therein, there might be situations wherein you require to reverse the impairment loss that you have earlier charged. Okay, so it says that firstly, the impairment of goodwill is never reversed. Your first star point is the impairment that you have charged towards goodwill is never reversed. Okay, why so? Because now if you are earning anything, if your business is growing again and it's building its name and fame, and you are getting any extra benefit, then this is your self-earned asset. It is your self-generated goodwill. And as we know, yesterday we have discussed, self-generated goodwills are never recorded in books of account. Therefore, no reversal will be done ever for the goodwill account. Here, secondly, we can reverse impairment loss, but there is a maximum limit set. Okay, we cannot reverse the impairment loss more than the carrying amount that would have been if the impairment was never booked previously. And why this is so? Why this is so and how? Have you noted this?
No, maybe don't.
Okay. If you're done noting, give me a thumbs up. We'll go ahead. Okay, good. Okay, next. I'll give you an example. And why this clause has been introduced, I'll give you the reason also. For example, let's take two cases. For example, without impairment. Without impairment. For example, we have a cost of asset. Okay, and for example, it is 1,000. And you're following a depreciation of 10%. Okay, on the cost itself, SLM, $100 each year. So, depreciation in year 1 is $100. Okay, and therefore the WDV is 900. Then depreciation in year 2 is again $100. And therefore it is 800. Got it? Depreciation in year 3 is $100. Again, your value is 700. Okay. Similarly, what happens with impairment? With impairment. For example, in year 1, the cost was 1,000. Okay. Later, again, for example, you charge your depreciation of 100. Okay, it was 900. Depreciation in year 2, for example, $100. Again, it is same. Now, before charging depreciation in year 3, you said that okay, there is a depreciation as well as there is impairment loss. Okay, of $100. And for example, of 250. This means your carrying amount is now 800 minus 100 minus 250. Sorry, 450. This is your carrying amount. For example, later in the next year, you're again charging a $100 depreciation in year 4, and it is 600. Please understand. For example, in year 4, you get to know that your recoverable amounts are, for example, $900. Got it? You said that the recoverable amounts are $900 in year 4. Your carrying amounts are 450, your recoverable amounts are $900. Okay? So, normally what would have happened? The reversal of impairment loss is allowed. You would have added $450 and your recoverable amounts are 900. But this is wrong. Why? It says that you can reverse your loss of impairment maximum up to an amount which could have been if no impairment was ever taken into consideration in earlier years. This means the maximum amount that will be after reversal of impairment loss is $600. Is $600. Okay. So despite your recoverable amounts being 900, still your reversal of impairment loss will be restricted to $600. This means it will be restricted to 150. Got it? Reversal of impairment loss. And why it is done? Because otherwise the companies would have misused it. The companies would have shown like thousands and millions of impairment losses in year 1, year 2. And in the year 3, when they are going ahead with issue of more IPO and they're raising funds, they could have reversed their impairment loss with higher and higher amount, okay, and shown their PL at profits. So everybody who is investing, the investors, prospective investors, will look at the PLs and they would say, in the previous year it was so much loss, then in the next year it was so much loss, but in the current year, since it has come up with new ventures and all, now the company is able to make so high profits. These are not actually high profits. Instead, it is just because of the difference of reversal of impairment loss. So in order to restrict reversal of impairment loss, in order to not misuse the reversal of impairment loss concept, they have put a restriction. That maximum amount up to which the asset can be reversed, can be brought back to the carrying amount, is the maximum amount which would have been if earlier no impairment was taken into consideration. So we know that because of this, there is $450 difference. Between 450 and 900, there is $450 difference. But you cannot reverse the entire amount. Instead, it will be restricted only up to 50. Is it clear? Any doubt? Any doubt? So our question, please confirm. Any doubt? We have to restrict our reversal up to an amount which could have been if earlier no depreciation was taken into consideration, was never recorded. As if no impairment was ever recorded in the books of account. Okay. Quickly understand, no goodwill can be reversed with impairment loss. Reversal of impairment loss already charged to goodwill will never be reversed. Secondly, maximum limit is the carrying amount which could have been if impairment loss was never taken into consideration. Let's try this example. Super example, a head office building with a carrying amount of 140 million. Okay, so there is a carrying amount of 140 million. Is estimated to have a recoverable amount of 90 million. Due to falling property areas in the values in the area. So now it has a recoverable amount lesser. Are you required to charge any impairment loss? Is there any impairment loss? Yes or no?
No.
Okay. Any other answer?
Yes, there is impairment.
Yes, there is impairment loss because the carrying amounts are higher.
And
The book
recoverable.
value of the asset is 140, whereas the recoverable amount is $90 million. This means the books have been overstated and we have to record an impairment loss of $50 million. Please give me a quick thumbs up. Is it clear? Since carrying amounts are higher, the books have been overstated. The head office building have been over-recorded in the books of account as compared to the recoverable amounts. In this case, we have to book impairment loss. We have to reduce our head office building amount by $50 million. Is it clear? Kishan, is it clear? Harishankar, clear? Good. Okay. So this is your step number 1. Step number 2. After 3 years, property prices in the area have risen and recoverable amount of the building increases to 120 million. Okay, so in second case, your carrying amounts and your recoverable amounts. Please understand. Your carrying amounts are $90 million, but your recoverable amounts are $120 million after 3 years. Okay, due to change in the amounts, the recoverable amounts are $120. The carrying amount of the building, had the impairment not occurred, would have been 110. Is there any reversal of impairment required?
No.
Why no?
When you test again, recoverable amount is more than your carrying amount.
Yes. Okay. This means now you have to reverse. Yes. Reversal of impairment loss is required. Okay. For how much amount? Amount will be okay. Or okay, without amount, but restricted to a carrying amount of $110 million. You cannot increase your carrying amount after reversal of impairment loss more than 110. That is the amount that could have been if in earlier years impairment was not taken into consideration. Please read this line again. The carrying amount of the building, had the impairment not occurred, would have been 110. So while you are reversing your impairment loss, you have to restrict your value up to 110. This is the max limit for reversal. Okay, this is the maximum limit which should not exceed after the reversal of impairment loss. So the impairment loss difference is $30, but you have to reverse only $20 million, and your carrying amounts after reversal will be 11. So what is your impairment loss reversal? Only $20 million. This is your answer. Reversal of impairment loss. That is 110 million minus $90 million. Is it clear? Generally, the reversal will be of $30 million, but you cannot exceed your carrying amounts more than the amount that could have been if no impairment was earlier taken. Okay. If we carry on with this example, okay, your carrying amounts are $450 and your recoverable amounts are $900. Okay. you have to reverse it. Reversal of impairment loss. But restrict it to maximum limit. Okay, which is carrying amount, of asset without impairment. What is your carrying amount of asset without impairment? $600. Carrying amount without impairment loss is $600. So you have to restrict your reversal up to, that is, $600. So this means you will reverse, okay, but after reversal, your asset amount, carrying amount should be $600, not more than that. Because of this, you have to reverse only $150. This is your answer. Reversal of. Please unmute and speak up if there is any doubt. Please don't hesitate. Any doubt, any cross question? And why we are restricting it? So that the companies are not misusing this funda. Okay, they are not showing your 600, instead of 600 they can show 1200 or 1500 and say that okay, it's a reversal of impairment loss. They can increase their profits, okay, and they can show wrong figures, okay, misleading figures to the investors. In order to make sure that it is not being misused, we have restricted an amount. This is the amount of the carrying of the asset, which could have been if earlier no impairment was ever taken into picture, was never affected. This is $600. This is the maximum limit, which should be after reversal of impairment. So our carrying amounts are this, and 600 should be after impairment. Okay, carrying amount before impairment loss, before reversal of impairment loss, carrying amount that could have been after reversal of impairment loss. This is your max limit. Is it clear? Anybody, any doubt? Are we clear on this also? The carrying amount after reversal will be 110. The reversal of impairment loss will be 20 million. Please give me a quick thumbs up. Is it correct? Is it all right? Do you understand? Good. Okay. Take a screenshot. Try this question. Okay, understood? Revise this topic. Okay, I'll take a quick revision in the next session, and then we'll start new topic. Okay, try this question. If there is any doubt, do either ask in the class or you can write it in the WhatsApp group. All good? Give me a quick thumbs up. We'll end this session. Okay, okay. Thank you.